Sam Springer, one-time mining analyst of the year. He's now running Kincora Copper. He joins Mining Matters to tell us a bit about the industry that he's in and the commodity he's focused on. Sam, how are you doing?
Really good, thanks, Alistair. Good to see you.
Yeah, good to see you too. You got some nice splashy colours behind your head there, I see.
Try my hardest.
So you know a thing or two about the business you've been in. You've been running Kincora for many years, and you've been a prominent mining analyst before that. So tell us about this space, copper. What are we talking about here? What's the metal? Why is it useful? They call it the bellwether of the global economy. Why is it so significant?
Yeah, I mean, copper's a fantastic industrial metal. It's one of the most conductive metals out there and cost effective for that purpose. So from moving electricity, the decarbonisation of the world, copper plays an essential role within that. And the interesting thing that we're coming towards is this long-standing conversation of, are we able to, as an industry, keep producing enough copper? And that's something that's been in the news a lot recently over the last couple of years. This decarbonisation, moving away from carbon. Copper is one of the more essential metals in terms of absolute dollar value of metal needed to facilitate that transition. And I guess when you listen to whether it's BHP or the copper majors or the general diversified majors, there is, and most funds out there, there is a real consensus that copper will be an interesting space to be in because of the industry struggling to keep production at current levels and this expected demand growth. And I guess copper demand between 2 to 3 to 4% is something that is the long-term average. And to facilitate that, to meet net zero, would mean that there are all these new producing assets that are already in the pipeline that just aren't at the moment. So copper is one of those really interesting spaces that's got a lot of people's attention, but no one's quite sure when you're going to go from that sort of current stage, which is historically a very good price, but to a structural deficit where you just don't have enough new supply coming on to meet demand. And I guess the way I see copper is it's very much a supply story, by sort of new capacity coming on stream and the lack of new investment. So that sort of supply dynamic's always hard to have an exact trigger point.
So you're saying really that there isn't enough visibility, or there isn't a serious amount of visibility of where the copper is going to come from in the future, at least enough copper for future demand.
Most of the existing major copper mines have really been old mines, where grades declining, and it's been well documented that experience in Chile. You've had one project that's, I guess, come on since the last commodity cycle in a major way, and that's Robert Friedland's Kamoa-Kakula, in the DRC, in Ivanhoe. What an amazing discovery and development project that is. But that's really an exception to the rule. And this conversation of needing a new Escondida or needing a new Grasberg, some of the world's biggest and some of the oldest copper mines in the world, to be coming on stream to keep production flat is well documented. So it's a really interesting dynamic. But with all these things, given the lead time that every industrial metal faces, you can't just find a fantastic copper project today and it'll be in production in 5 years. The duration of building these and permitting and exploring these projects takes considerable time. And I think that's what's got people's attention, is that the lead time within, I guess, the expectation of when that demand is needed, there's a bit of a disconnect.
Well, you used to be in Mongolia in quite a big way, as I recall, and a keen student of what was happening at Oyu Tolgoi. So tell us a little bit about that in terms of the development times and the scale of what they were trying to achieve and how long it took them to do it.
Well, I mean, that's a fantastic example that you've got there, right there, Alistair, with OT. That is on track to be the world's biggest copper mine, fourth biggest copper mine by 2030. But that timeline of when that underground development project was supposed to come on stream and the capital costs to achieve that have both blown out very materially. But it's an interesting one, like the Southern Gobi in Mongolia on the doorstep of China, the world's biggest consumer of copper, is actually one of the fastest growing new sources of copper supply. You've got Oyu Tolgoi, you've got Savan Savaga, which is a $1 billion private construction project that's being built at the moment. You've got Xanadu's Karmataya project that Xi put its foot on and is nearing an FID decision point. So they're the sort of jurisdictions and development regions that a lot of this new supply is having to come from, as some of the more mature jurisdictions like, say, Chile or even Australia aren't ramping up in the way that they used to, and you're seeing declining grades and increasing throughput needing to try and compensate for that.
I mean, some of these names that you've been mentioning in the last few minutes are immense mines. I mean, we're talking about Grasberg and the mine that Friedland's just developing in the DRC. It might seem amazing to some people that mines that are so big are still unable to supply enough copper to meet the demand or the future demand.
Yeah, and that's where copper is one of those really important minerals, but it's I think the fourth biggest end market in terms of actual dollar value. It's like oil and iron ore, they're big established markets. There's a lot of talk about critical minerals, and a lot of those critical minerals are growing from a relatively small end market in terms of dollar values and some fantastic growth figures. But that's the really interesting thing about copper, is that you've got mid-20s worth of primary copper million ton production a year. To go and find another big copper mine, you might get 500,000 tons a year. So you really need to have a significant pipeline of those sort of projects coming on stream.
So is it really all about the electronics in the batteries, the greening of the economy needing to have more wiring in it? Is that really what's driving the demand?
Well, it's industrial production. If the world's still growing and we're still building things, you're going to keep needing new copper, and there is that sort of baseline. If you are looking to try and decarbonise and move away from traditional carbon sources of energy, whether that's coal power plants or whether that's moving to electric vehicles from traditional combustion engines, that all requires a multiple more copper. And then that's reworking the systems to deliver that power to those units. So it's the whole supply chain that needs a step change. And a lot of that existing infrastructure there is quite old. So Friedland's talked at great lengths about the amount of capital that's needed in the US to effectively upgrade the networks there to be able to make that transition to net zero, and it's huge numbers, which again is where the industry is already sort of struggling to keep supply flat. How do you then meet that incremental demand from these new world sort of end users?
Well, what about recycling? Is that something that comes into the picture here?
It is, and these tariffs that are taking place at the moment with the US and particularly China is sort of throwing up some interesting movements within sort of the recycling and scrap market. But that's not the end game. You're still going to need the majority of copper units coming from new supply. And you've seen China recently produce a lot of new smelting capacity, and there's not enough copper con that's reliable enough to be able to keep those, I suppose, smelters at very profitable levels. You're seeing sort of near record low TCRC treatment charges reflecting that market dynamic.
So I guess, I mean, the assumption is that there is enough copper out there that could be found hypothetically. Is that a correct assumption, or is the world going to just run out of copper at any point?
Well, I think it's sort of like lithium and a lot of rare earths. There's plenty of them out there, but can you economically extract them? And the biggest primary source of supply of copper is copper porphyries. And copper porphyries are generally large, low-grade systems. If you find a high-grade gold-rich copper porphyry, it's probably the biggest prize from an exploration development perspective in the hard rock industry, but they're quite rare and they're increasingly deep. So I think that dynamic's quite an interesting one there too.
So what is a copper porphyry then, Sam? Could you just explain that to us a little bit?
Yeah, I won't go into the geology there too much, Alistair, but I guess it's a large-scale hydrothermal event. Think of an island arc setting with volcanoes. They're generally, by the scale of these mineralizing events, quite large scale, and particularly if you can find a gold-rich copper porphyry, they can be the largest prize that you can find in the hard rock industry. So they're the sort of assets that whether you're a diversified major, a copper major, or a gold major, given the gold credits you can quite often find with these, they're the sort of assets that fit within those major mining groups' portfolios. Long life, relatively homogeneous in terms of the mineralogy and metallurgy. So they can be quite large bulk extraction operations. So yeah, a copper porphyry, if you Google that, you'll get much better geological answers than that. But from an economic and minerals exploration perspective, they're a very significant prize if you can find one.
And there's often gold associated with them, I believe.
Correct. And I guess that gold credit, particularly with gold trading where it is now, is quite an attractive byproduct and means that you're seeing a lot of the gold majors active in this space. Barrick Gold, I guess, is Barrick Mining, or changing its name to be so, to reflect that there's been, I guess, no hiding the fact that they're keen to increase their exposure to copper. And I guess the copper quite often helps in terms of that social license to operate. And that's where you're seeing, I guess, a lot of M&A activity from the traditional gold companies within the copper porphyry space, where you've got that attractive gold credit.
Yeah, so you talk about M&A and Barrick, but I mean at the other end of the mining market, the junior end, I understand if you find a porphyry, they often come in clusters, so I'm told. So if you're an exploration junior and you find one, you might be able to get your hopes up that there's more than one on your ground.
Oh, you quite often see that the key with porphyries, and they can be very hard for a junior to sort of do from a making money for shareholders perspective, because of the relatively capital intensive nature of them and the timeline that's needed, the amount of drilling that's needed to define them. But the real key for an attractive outcome for an exploration junior is, and from a development project perspective, is to have a high grade core. Say Cadia Ridgeway, which is the largest copper porphyry mine in Australia that Newmont recently sort of acquired from Newcrest. Cadia Ridgeway was really what made that deposit fly, because you were able to pay back that capital from that high grade core, and now they're mining pretty low grade, sort of zero point 0.4 gold, zero point 0.4 copper below that at sort of circa 600 to 800 metres depth, and doing so very favourably at pretty much negative operating costs, because that capital has already been repaid. So I guess the key thing for juniors exploring these large mineral systems is trying to see that high grade core so you can get a quicker return on your capital.
And so you mentioned the expense of drilling. I mean, I've seen a couple of companies over the years just sort of break their hearts over looking for copper porphyries, because they've got all the indications and then they just burn so much money drilling and it never quite sort of comes to fruition. Is there any sort of way you can avoid that, or is it just a question of where you got to use the rotary truth machine and you don't always win?
Yeah, and it's quite often the case of having the courage to walk away if it's not cutting what you need. Your question in terms of the outlook for copper, is the world ever going to run out of it? Well, if you start moving cut-off grades down, all of a sudden there's a lot of projects that aren't economic at today's prices that all of a sudden, in theory, could be. And a lot of them are these large, low-grade copper porphyries.
So we could end up in an environment where the copper price just goes high enough to bring a load of uneconomic copper projects back into the world of economic projects, and then the price will stabilize at a new level, I assume.
Well, the challenge, and you're absolutely right, that's what we've seen in previous cycles. But I think the challenge is the lead time to develop these projects, and the challenge to be able to fund them. Because I think if you've got a project that only works at $5 a pound copper, you're going to need copper to overshoot beyond that for quite some time, or a step change in the industry before financiers are going to say, here's the money for a 5-10 year build. We feel confident on that price being sustainable. So you quite often see the research reports talking about what's the incentive price needed to see new projects getting built. And I think we're not seeing that new supply from this new sort of higher price environment coming through yet. We're still really, other than Kincora Copper, seeing a lot of like OT projects that were the last commodity cycle, those large scale projects. They're just coming through into production now. And once that drops off, that's where this interesting supply demand dynamic kicks in.
But I mean, I would say, I don't know if you'd agree, but a lot of people have lost faith with the junior mining sector over the last decade or so, just because so much money has been lost or, spent unwisely, and investors have been burned quite badly. So, I mean, is there a case that actually the new projects aren't coming along because there's just no appetite from investors to put the money into it in the first place?
Oh, there's a whole range of different issues at play here, and discovery rates are decreasing. A lot of the outcropping copper projects are being found, or those that remain are in unsavoury jurisdictions where sovereign risk is a real impediment. So that's an interesting dynamic. But you've also had, since the last commodity cycle, a real, and now you're starting to see these companies return to growth. Naturally, you start trying to buy existing units. You go for the producing projects, looking at M&A and consolidation. Then you look at the development projects. Then you're looking at brownfields opportunities and near mine expansion, because if you find another deposit next to an existing mill, you get a fantastic payback on that. But greenfield exploration spend is not returning back. And a lot of the majors cut greenfield as a business function or budgets very significantly last commodity cycle. And I guess after a couple of years of this returning to growth, you're seeing people with the majors starting to return to greenfield exploration, but not in the same way that they did it last time. Headcount blew out, expenditure blew out, discovery rates decreased. ESG was hard then. It's only getting harder now in terms of the complexity and the lead times for those things. So you're actually seeing a lot of these groups that are resuming greenfield exploration, doing so by doing deals with juniors. And I think that's where there's a recognition of the juniors are a bit more nimble, they're a little bit more cost effective, but the majors would prefer to do win-win deals where they put a foot on the project, which is ultimately what they're after. And if that junior has a new tier one greenfield success, everyone will do well from it. But they don't have that internal bureaucracy and the problems that they had last commodity cycle by having that greenfield function in-house.
Well, I've seen a couple of these cycles now because, I'm a bit long in the tooth these days. And I'm not quite sure what stage of the cycle we're in at the moment. But if we're at the very early stages of the cycle, then perhaps my comment to you, Sam, might be that, well, you haven't seen the exuberant stage yet, because the majors always seem to stuff it up somehow when the cycle is really rolling. It may be that they're being cautious at this point, but speculation from my side at least would be that they won't be cautious when the next bull market really is in town.
Well, I think the reality is at the moment that the cost of capital for most explorers is still pretty significant, whether that's on the ASX, TSXV. That appetite to do greenfield exploration still isn't there. And I guess that's where we've tried to change from Kincora Copper's perspective, our funding model somewhat, because the recognition of, say, we pivoted to New South Wales around 2020, 2021, we drilled 30,000 metres of drilling through funding that through the public markets. Doing another 30,000 metres of drilling, the cost of capital there is pretty expensive. So what we've tried to do is change, given the cost of capital from the public markets and this dynamic of the industry majors starting to resume looking for greenfield exploration opportunities, and doing that by doing deals with juniors. And I guess we've tried to adopt what I guess the North Americans would more commonly refer to as a prospector project generator type model, where you're effectively looking to get partners at an asset level, and that way you've got, as a listed company shareholder, you're getting dilution at the project level, not the listed company level.
And that prospect generator model has always interested in me, in part because it never really caught on in London. I mean, a couple of companies tried it, like Altus Strategies. They did quite well, but then they just got acquired. So that was the end of that. And almost everybody else in London has sort of, they've played around the edges of that idea, but never really managed to sort of make it work. So, I mean, why is it that the North Americans can do it? You can do it, but nobody in London seems to be able to get that idea off the ground.
Well, we're trying to do it. It's taken us sort of 12, 18 months to change our funding model, and we've just started to do deals. We've done 6 deals with asset level partners that's unlocked potentially over $110 million worth of partner funding. We saw 7,000 metres of drilling in the fourth quarter last year, over $3.5 million worth of partner funding, and we're just starting to ramp that up now. But we're a little bit of an anomaly on the ASX. Ausquest has pursued that strategy in a partner model with South32. There's a couple of, I guess, hybrid types where you've got NSRs that pay for G&A and exploration expenditure, and you're looking at Emerson, you're looking at Talisman. But on the ASX, that's not so common. You're more generally on the ASX seeing players that are more brownfields exploration types. Historically, if a junior does a deal with a major, it's probably not perceived to be a win-win. It's more of a win-lose. The major does well, the junior not so much. The Canadian side, I think, is more focused on shareholder dilution than the ASX too. And that concept of dilution being at the asset level is something that, again, is more established within the TSXV particularly. But I completely agree with you about Altius. That was a great benchmark in London. The other one that I should note is Greatland Gold. And obviously that's changed more recently. But when they had an earn-in deal with Newcrest, Greatland went from about a £50 million market cap to over 1.5 billion market cap, so a 20x, while Havieron was looking like it potentially could be a tier 1 asset. So there are a number of these sort of prospector project generator models that have been fantastic success stories, and particularly when the cost of capital is relatively expensive. It just means that going back to shareholders every 6, 12, 18 months looking for another round of exploration funding, you don't have that concern. And quite often you're seeing, given the dynamics of this market changing and the majors starting to wanting to put their foot on new projects that have large-scale potential, you're quite often seeing placements at a premium, or you're even seeing management fees being given in terms of the juniors, the operator, they get a 10 or 15% management fee. And that's the sort of model that we're trying to get towards, where ultimately if we can have a scenario where management fees are covering G&A and corporate costs, and you've got a partner that comes in, looks under the bonnet, likes the technical merits of the project, de-risks the project from that perspective, but's giving the junior, giving us the exploration budget, that hopefully provides shareholders a pretty attractive scenario. And then if we do find a big discovery, the majors got what they want, they've got their foot on that project, while for our shareholders, you're not putting your hand in your back pocket and you've got a major that's funding and taking that exploration risk as a partnership.
So when you're talking about management fees, what you're saying, I assume, is that your partners will pay you to sort of run the project. Is that correct?
It is. So we've just in the last month announced a second earn-in JV agreement with AngloGold Ashanti, one of the big gold miners in New South Wales, exploring for a new district in the Macquarie Arc, an extension of the existing belt. And we receive a 10% management fee of expenditure. So we commenced drilling in the fourth quarter last year, for example. That was about a $1.5 million program. That's $150,000 that goes to your G&A, plus all your obviously exploration costs and that function being absorbed by the earnings. So that business model, when capital's tight, if we can get to a self-funding model, certainly provide shareholders at the listed company level a hell of a lot of leverage. And obviously that provides the technical endorsement to shareholders that these groups are one, seeing the management team is very credible to lend their brand to that and lend their name and their funding to it and letting you operate. It means that from an ESG perspective, obviously it's a tick of approval of going through and operating in the right way. But from a technical perspective, it means that there's endorsements on the targets and the concepts that you're looking to test.
I mean, I guess to sort of put it simply as well, or to look at it in a simple way, it also means you can keep moving. You know, you don't have to stop, wait for the equity markets to deliver some kind of, you know, attractive form of funding. You don't have to, you know, reconcile your shareholders to yet another round of dilution and spend a lot of time, you know, wiping up their tears. You can just keep moving on the projects.
Well, and I think that's the really attractive thing is not having that dilution. Say, for example, where we're exploring in the northern extension of the Macquarie Arc, we've got what we're looking for here is a new district scale play. There's over 2,000 square kilometres included in 5 continuous licences where AngloGold Ashanti has the right to spend over $100 million, up to $100 million to earn into these projects. What we're looking for is a new district. Down to the south, where it's more outcropping, subcropping, you've got 160 million ounce gold equivalent. As you go up to the north, you go under post mineral cover. That's not been well explored. And to put that into an analogue perspective, you look at Vicuña in the Central Andes, an extension of those Central Andean belts that goes into sort of Argentina. That hadn't been well explored previously. That's at 4,000, 5,000 metres. And you've had the Lundins come in, make a fantastic discovery with Philo. Then NGEX has also made another good discovery. That whole district within Vicuña, with the deals that were done with BHP and Lundin, valued 4 discoveries that are pre-development at over 10 billion Aussie dollars. So that's what we're sort of looking for in this northern extent of the belt. And through the deal that we've done with AngloGold Ashanti, our shareholders, if we had exploration success, wouldn't have to put their hand in their back pocket to the equivalent stage of those 4 discoveries that are being valued by BHP, the Lundins and the market at over $10 billion. So that's where this business model can be really interesting when you've got that sort of scale.
So when you talk about a district up there in the Macquarie Arc, are you talking about what we were mentioning earlier about, you know, clusters of porphyries, or is it bigger than that?
Well, the portfolio that we've got covers 100 square kilometres of continuous licenses, so it is that sort of true district scale. If you were to compare that with, say, Vicuña over a circa 50 sort of kilometre strike, you've got 4 new discoveries that are being valued at that $10 billion number I was mentioning before. And that, I guess, is your classical porphyry cluster. We go back to the Mongolia example of Oyu Tolgoi, you've got a series of these deposits along a key structure. And that's, you have the open pit, then you've got Hugo, Heruga, etc., within that cluster that covers 20 kilometres. But quite often these structures occur on very important transverse structures. And that's where, again, as an explorer, you look to be in the right setting, you get into the right systems, and then can you find that high grade core within that first deposit, and then try and find the next one. So yeah, there's a well-proven exploration model out there.
So let's talk about that a bit. I mean, you've got this district up there. You're talking about drilling it, but presumably you've had to do quite a lot of work already to get to that point. What do you have to do to get to the point where you want to drill?
Yeah, and again, different projects at different stages, but using our ground that we've got in partnership with AngloGold Ashanti as an example, what we're looking for is, as you say, a series of potential deposits. So we're doing scout drilling undercover into a part of the world that's had very little, if no drilling at all. trying to see if we're in the right rocks. And say Cadia, the biggest porphyry in Australia, the example that I gave before, that was sort of the flagship mine of Newcrest that Newmont acquired, that sort of footprint is 5.6 kilometres, sits on a key transverse structure. Can you find one of the two skarn deposits or series of porphyries that sit within that and prove that you're in the right rocks? If you do, then that exploration increases, the dollar spend multiplies, the management fee we get multiplies. You get onto a discovery and you get to a drill out phase. That's probably when the keys to the project go over to the major and they start looking at that in terms of how do you optimize the discovery. But that's what we as a junior should be able to really leverage and benefit. And there's existing state level data from regional magnetics and gravity that does a really great job of mapping these volcanic arcs, both in the subcrop up to undercover.
And what sort of depths do you tend to find porphyries at? Is it all types of depths, or is there a pattern?
Oh, you'd love to find them near surface with any mine. The
Yeah.
closer to surface, the better. But I guess with these porphyry systems, it's also a key thing is the preservation level. Sometimes you'll have a porphyry that outcrops, but the best parts of it, the highest grade parts, were eroded away many millions of years ago. So I guess that with all these things, if you can find a high grade core that's close to surface and it might give you an open cut, that's the holy grail.
But the assumption might well be that actually the best high grade porphyries have already gone.
Oh, yeah, no, there can be. I mean, you look at the Golden Triangle in British Columbia, there's new search spaces being opened up by just the melt of the ice and access that wasn't previously there before, deforestation. Or do you go to jurisdictions that were difficult and all of a sudden opening up? Or is there new infrastructure that opens up a new district? Or say, for example, what we're trying to do in the covered extensions of the belt, people were previously looking for open cut projects. So that depth undercover meant that they weren't that interested. But potentially the biggest part of the Macquarie Arc is under this covered extension. And if you've got 160 million ounce gold equivalent endowment to the south, you really do have that new district scale potential up to the north.
So if you get on and drill it, then what depths are you going to drill to?
We're finding the cover, it's variable in different areas, and again over 100k strike, some of that will materially change. We're hitting basement at some of these holes at about 200. We're seeing some holes at 350. You probably don't want to be going for something plus 500, but you look at, say, IOCG systems, and a lot of those projects are deep. You have a look at the Resolution Copper project in Arizona in the US. That's a deep project. So it all depends on tons and grades and the economics of what these projects need. But I guess the exploration threshold that we're really pursuing, we feel pretty comfortable if we can find something 200 to 300 metres below surface, given the scale of what we're looking for.
So you think you might have IOCG there as well?
No. What we're very much looking for porphyry copper. It's the main in Australia. The main IOCG belts are, I guess, up in the Gawler Craton in South Australia, and then sort of Mount Isa in Queensland. But really, this part, the Macquarie Arc in central west New South Wales, it's a well established, well known, well researched porphyry belt, and very similar to a lot of other globally significant porphyry belts.
So how can investors spot a company that stands any chance of success? I'm thinking about Greatland, which you mentioned earlier. And I mean, I remember when Greatland was knocking around, I mean, I'm going to say 15 years ago, maybe even longer ago. And there wasn't really anything that indicated that that was going to be the one that was going to really fly. So, is there any way investors can kind of conduct analysis or, put their finger in the air and test the wind or do they just have to sort of take a punt on the promotional efforts of the management of the various companies?
Yeah, it's a really tricky one, Alistair. I mean, I have to admit, I was watching the Cascabel discovery of SolGold's looking at these numbers and going, this looks like a fantastic discovery, but the share price wasn't doing anything. And I'm like, I must be missing something here.
Yeah.
And then Newcrest came in and sort of provide that technical endorsement that this is a real bona fide discovery. There's no warts on this. And you saw that thing re-rate really hard, really quickly. And unless you're an insider and you've got a geological or that technical insight that you can do that sort of analysis yourself, or you're following newsletter writers or research that have that particular skill set, I'd probably say one of the key attractions of this project to generator model that we're looking to adopt with our projects is you're effectively getting a major to come in and do that DD and technical endorsement on your behalf. And they're providing that funding as well that basically means that you're aligned to listed company shareholders. So if you're a retail investor and you want to try and play in that space, I suspect the project to generator model is, again, something that's pretty interesting and worth considering.
I mean, I remember Sol Gold as well, and I can't quite remember the numbers, but in my head, it's coming up as extremely long intercepts at very high or comparatively good high grades. And, you know, they were just putting these releases out with the naked numbers and not getting any attention. And I sort of think, well, actually, in that case, you know, an investor did have quite a lot of the information that they would have required. But still the shares didn't move anyway. So it's a sort of paradoxical situation that you're just, you know, you've described there.
Yeah, but I think if I recall correctly, Newcrest coming on board was one of the key things there that really got the share price moving, because it provided that technical endorsement, both on the geology but also the jurisdiction, that sort of alleviated some of the concerns that might have been in the market at the time.
It went from about, I mean, I'll pluck a number out of the air, but it was something a lot of the order of about 30 or 40 million to about 400 million, I think, in relatively short order once that happened.
And there's a great history of copper porphyries giving shareholders that 5, 10, 20, 30x. And again, one thing that we've got in our sort of corporate Kincora Copper corporate presentation at the moment is recent success stories within the copper porphyry space with this project generator model. We've got a direct peer, Inflection Resources, listed in the CSE that's a 3x from having done a deal with the same partner as what we've got, Anglo Gold Ashanti. They're exploring in the same belt of rocks undercover, one project literally adjacent to and next door, as close as 1.5 kilometres away. That's been a very good success story, and they've got similar results as what we're starting to see come out of the ground. You've had AMARC that's got 2 earning deals with a couple of majors. They're a plus 100 million market cap, having done some good exploration and getting some good results within the porphyry space, the Golden Triangle in Canada. But then you've got a number of other examples like Greatland Gold that are out there that are your sort of classical 20 to 30x. And that's where this business model, you're not facing the same dilution, but it's not on the flip side giving you lesser return and an upside profile.
Yeah, I mean, I talked to Sean Day not long ago, and he's basically, you know, he's got some big plans for sort of further growth as well. So it's not over yet.
Correct. And again, these copper porphyry systems, quite often, the more drilling you do, the bigger they get. That's the nature of the system. And again, that's why the majors generally quite like them.
So let's talk about the numbers then. So what would be a good grade of copper to see in drill core? And does it sort of vary depending on how deep you are?
It does, and it depends on the style of system. So a SEDEX system versus a VMS versus a porphyry. But as really rough rules of thumb, these days, if you've got 0.6 copper in an open cut that hangs together relatively well, that's probably pretty interesting. If you're looking for something that is potentially an underground operation, you're probably 1.2, 1.3 is a minimum copper equivalent, and depending on the shape of the system and the depth of the system, that all those sort of factors have a significant influence.
What's happening to I mean, you mentioned copper equivalent there, which is when you bundle in other commodities. But what's happening to the copper equivalents, given that the gold price is so high? Is that sort of changing the way the copper equivalent numbers are worked out?
Yes and no. Again, as a big generalisation, it depends a lot on the metallurgy and of what the byproducts are. But generally, within copper porphyries, and unless you've got a lot of arsenic in there, and that's one of the challenges in sort of the Vicuña district, a lot of those systems do have a lot of arsenic. Copper, if you have a clean copper gold con, yeah, the economics of what you're getting is really attractive. And the same, the moly price has been very strong. And you see most moly coming from as a secondary product from generally copper porphyry systems. So again, that sort of mix is really pretty important when you look at the economics and when you're trying to assess these projects. But again, from an exploration play of, are you a retail investor and you're not going to own this thing in 5, 10 years when you're actually doing studies or thinking about permitting and building it? Quite often that headline of making a new discovery with those sort of 0.6 as an open cut, 1.2, 1.3 as a copper equivalent for something that could be an underground will generally be well received in the marketplace because there's not a lot of new discoveries out there. There's a lot of projects that are being recycled. But if you find a genuinely new project, you're going to get a lot of interest from the market, but also the industry majors.
Is there much of a space in this sector for small copper mines? I mean, we talked earlier on about the immense mines. How about any small producers? Can you make a decent living as the owner of a small mine?
Oh, absolutely, and particularly VMS deposits. Sirius was a great example with De Grassa that had a relatively small resource, relatively short mine life, but made a huge amount of money. That you had a very good copper price with very attractive byproducts. And Meridian Mining in Brazil, which one of our old colleagues from Ocean Equities, James McLucas, is involved with, is onto one that looks really attractive, fantastic economics, and that's on one of what will probably be a cluster of deposits as well.
So McLucas is in the copper business too. I didn't know that.
Well, I think Gilbert Clark's the key guy, but no, James is trying his best.
Yeah, so that takes me back. I mean, there's quite a lot of people who know each other in this business, aren't there? It's not that big a world.
Absolutely correct. And that's again when investors are doing due diligence, having a look at who the team is absolutely critical. Particularly for exploration players, you've got to say, well, what's their track record? Most geologists are optimists, and not many have made big discoveries before. But it's like sporting sort of legends. It seems to be the same people that repeat winning things that make these discoveries. And if you're looking at development projects, you want to look at teams that know how to go through that process because it's a really challenging process. And if you haven't done it before, it's probably quite hard to do it successfully first time around new.
Yeah, the guys at SolGold, who we mentioned a moment ago, the discoverers of Cascabel, I think they discovered a big project in the past as well. So they were coming at it with a track record of success, and that's partly why Nick hired them at SolGold because he knew they
Yeah.
would, and then they did deliver. So that was quite.
Malcolm Norris and a few of those guys had a fantastic track record of making discoveries, and they're still making new discoveries down there.
But what do you think about having a geologist as a CEO of a company, Sam? Because some people don't approve of that. They think that the money is not going to be spent wisely. It's all going to be, too much ground truthing and not enough economic thinking.
I think that's a loaded question if I've ever heard one answered. But I think with all these things, with particularly the challenges of the cost of capital for junior markets, you've got to have, there can't be any passengers. You've got to have the right mix of people who can go out, tell a story, engage with the capital markets, then put that capital to work very efficiently in the ground and get good results from it. And then you've got to be able to make sure that you've got a good relationship with your stakeholders and covering ESG considerations. So that's one of the challenges as an industry, is that skill set is getting more and more complex, all those different facets. And you really, if you don't have that well-rounded team, even if you have technical success making a discovery, the wheels could fall off. And getting that funding model, particularly if you're looking for big systems, is really important. And that's one of the things that we have tried and get right. And you look at Kincora, we've had a couple of very material pivots in strategy. We pivoted from Mongolia to New South Wales because it was a period of time where raising funds for Mongolia was really difficult given what was going on with Oyu Tolgoi and a number of projects and the legislative environment. And then we moved to New South Wales. We had some good results, and we've more recently just made this pivot in funding model to asset level partnerships because of the cost of capital. And again, that's one of the challenges within our sector, is you've got to be nimble. And quite a lot of companies have had a number of different phases or changes or assets to try and get that mix right. But when you get that mix right, you can have fantastic results.
I mean, you yourself have got, significant amount of experience in London. We mentioned that at the beginning of the conversation, and now you're back in Australia and have been for several years. So you've got the Australian angle sort of sewn up, and Kincora's also got a kind of Canadian presence as well. So it's quite an international outlook that Kincora has, even though the assets are broadly now focused in Australia.
And that's, yeah, I guess I was involved London days helping set Kincora Copper up. And at that stage, the natural market for a Mongolian project was the venture exchange. Friedland put Mongolia on the map into North America through the original Ivanhoe and the discovery of OT. I think there were 3 or 4 resource billion-dollar market caps listed in Canada. That was the natural market. When we shifted focus to Australia in 2020, 2021, people like investing in their own time zone. They're more familiar generally as of their assets in their backyard. And that's where we dual listed in March 2021, and we were fortunate with market timing there. But that said, there are sort of exceptions to the rules. Southern Cross Gold's just gone and dual listed on the TSX fee, and the reason for that, for a Victorian gold project in Australia, is that people made money out of Fosterville, and that was a huge success story. And most of the people that made money out of that was Kirkland Lake, I guess back in the day had that, Anico Eagle, I guess more recently. But that was hugely profitable, and people who made money out of that trade were normally North America, and they're familiar with that. And what Sunday Creek is that Southern Cross has is a real analogue to that. So that's an obvious one that you're probably getting more love in an international market. So there are always exceptions to the rule, but I guess the really interesting thing, Alistair, is when I was over in London over sort of 14, 15 years ago, at Ocean Equities, Australia wasn't probably as buoyant as what it is now. And you had the AIM market being healthier, and you had the Canadian market being the number one market for exploration through to development plays. And by far, there's more money in the North Americas than Australia. But these self-managed super funds, and I guess a lot of juniors that actually became producers in Australia, has meant that there's probably a healthier ecosystem, and obviously benefited from the huge rise of iron ore and a few commodities focused specific events. While the Canadian model has generally been make a discovery, sell the project to a partner, or go down the project generator type model. And that has probably meant that there wasn't such a bigger ecosystem of that next tier and next generation of developers and producers coming through. And I guess things like medical marijuana weren't really a thing in Australia. Well, that sucked, and crypto's probably sucked more capital out of the traditional resource space in the North Americas than what you've seen on the ASX.
I mean, that seems true to me, that in the broad sense that speculative money now has plenty more places to go. Whereas in the old days, if you wanted to speculate and recognize that it was quite speculative, you could go into junior mining, and that there wasn't much else. Now there is.
Well, and I guess the lead time is a lot more challenging. Like you go into a biotech or you go into a crypto or medical marijuana play, you're not talking about these very extensive lead times that we've been talking about for how long it takes to get a discovery into production.
Well, also the amount of money it takes to get into production is, it can be immense. We were talking about Oyu Tolgoi earlier, and I mean, I shudder to think about the numbers that cost. I mean, there will be returns, but getting that money deployed up front is, some kind of big job.
Absolutely right. And again, that's the challenge. Coming back to that sort of query of where we are in the cycle, you are seeing M&A taking place. Say in New South Wales, we've seen $16 billion worth of M&A within the producing copper mines, the porphyry mines. You've seen over $385 million worth of earn-in deals being done with exploration juniors by the majors and industry groups. But it doesn't feel like that buoyant sort of top of the market time. Raising money is still difficult. You're not seeing those IPOs coming through during like what you saw in the COVID time. So every cycle is different, but hopefully, like what we've seen in a lot of other commodity cycles, it might start with gold and it might see rotation from sort of IT back to hard assets. And you'll see that traditional flow through to some more industrial metals and then from the producers to the developers to the explorers in time.
So now that Kincora is a prospect generator or a prospect generator in the making, does that mean it's less likely to be taken out by a major in the event of a successful discovery?
I'd probably argue the opposite, that you've already got a relationship with the partner. How many major mining operations have you seen a major wanting to have a junior in there alongside them? There's not many. Generally, if you make a big discovery, they'll want to own as much of it as they can, and there's probably quite a natural exit.
I suppose I was sort of more thinking about if you have a portfolio of prospects and one of them makes it big, what happens to the other constituents in the portfolio?
Correct. And I guess do those get spun out? You're absolutely right. Like say within our portfolio, we've got 14 copper porphyry projects. Obviously, we've done 6 deals to date. We've got a sort of, we think 3 of our more prized assets, more advanced de-risk projects that we're looking at partnerships for at the moment and further deals to come. How do you get that balance right? We make one big discovery. What happens to the other 13 projects? Well, that'd be a great problem to have, and obviously make it as scalable as what you possibly can.
Yeah. So there's lots that you've got to do. Do you ever think about going to any other jurisdictions, or are you pretty happy with where you're at?
I mean, we have over the course of the journey looked at all sorts of jurisdictions, and when we were looking at sort of growing and diversifying from Mongolia, we sort of looked where can we add value and where do we have a competitive advantage, and I guess at that stage you had some good discoveries that were being well rewarded by the capital markets in Australia, so that was an obvious thing for us to look at. Our technical director John Holday is probably the foremost expert in New South Wales porphyries. He was involved with the origination and discovery phases for Cadia. So we had a competitive advantage for how we were able to build the portfolio that we've got now in the portfolio within the company. Otherwise, what are we? We're just another junior. We're just another number. How do you actually have a competitive advantage in what's quite a tricky industry?
Yeah, I mean, it's hard to know where to go, especially from an investor perspective. I mean, obviously we were talking about South America a little bit. Chile, obviously the big copper producer historically, but not so easy for a London-based investor to find investable projects in South America. The London investor more likely to go to Africa or to Australia, really. So to some extent, it sort of seems like the world is a little bit parceled up into jurisdictional sections as far as the investment community is concerned.
I think that's a pretty good statement, and time zones are an obvious one. When we did our ASX listing, we saw a lot of existing shareholders in Asia move their shares over, with Computershare being the registrar, and both jurisdictions. It's very quick and cost effective to do that these days, and capital's pretty mobile.
So I think we probably ought to wrap this conversation up in a minute, Sam. But before we do, why don't you give us a bit of a insight into what's going to be happening with Kincora over the sort of coming year? What do you guys hope to be telling the market, and what do you hope to be achieving?
Yeah, I guess this change in business model, this last deal that we did with AngloGold Ashanti only in the last month, I think the penny started to drop for, okay, the company's changed its funding model. How scalable can it be? Well, there's 6 deals, 110 of potential partner funding. We've gone out on the record for the first time and said we'd like to be managing $10 million a year of partner funded drilling, for which we get a management fee that would cover our G&A. And you get to that scenario, and that's pretty scalable. That gives shareholders a lot of leverage. And we want to have a diversified group of different partners that are providing that asset level funding. So I guess we provide a slightly different set of catalysts to probably most explorers. You always live and breathe by your exploration results. We've got exploration results across multiple projects, but we've also got that sort of special sits, corporate type catalysts of doing further deals. The 6 deals we've done to date are for our earlier stage non-core projects. Our more advanced de-risk and, in theory, more valuable projects are the ones that we're trying to find partners for now. So I guess key things to keep an eye out for is drill results, your bread and butter in the exploration game, management fees ramping up, and further deal flow, and ultimately trying to get to that self-funding business model that you look at different sort of partner programs that have got that amount of exploration being taken place by whether it's Emerson, Talisman, Inflection, and some of the other peers on the TSXV. They're all pretty serious market caps.
So you talk about ultimately getting to self-funding. How close are you to the self-funding model as we speak?
I think one more deal away, and there's various different conversations we've got for the 3 remaining sort of more advanced projects that are in the portfolio. And
you mentioned just a minute ago your aspiration to do $10 million of drilling a year. For a junior company, that's a big amount of drilling.
Particularly when you're looking for a big copper porphyry system. If you find one of those, it's worth a lot of money.
So you can really see. So really, I mean, as we mentioned, one of the barriers to finding a copper porphyry for a junior company is that it costs a lot to do. But you're basically saying here that, well, we're putting together a model where we can actually deploy a significant amount of money in this quest, and so that gives us a fighting chance of delivering something big.
No, I think the key thing I'd sort of emphasise there, Alistair, absolutely delivering something big, but doing it in a way where you don't blow out your capital structure so badly that shareholders don't get a return for making that big discovery. And I think that's the really interesting thing about this funding model.
So just as a kind of final thought, then, just give us a little bit more detail about the structure of a deal. You know, a particular example that you might want to share with us, why the funding won't be hollowed out.
Well, I guess giving an example for one of the 2 deals we've done with AngloGold Ashanti, and we're sort of almost 6 months into drilling at the first of those, and the commercial terms are pretty similar. Is AngloGold Ashanti don't get anything, an economic interest in any of our projects until they've spent $25 million in each JV earning. Then they've got the ability to fund another PFS or another $25 million to increase their interest. So in theory, within these two earn-in deals, there's up to $100 million worth of expenditure, but 50 million before they actually get an interest in those projects. And at the moment, we're the operator, we're getting that 10% management fee. So say, for example, if we have a $5 million budget with AngloGold Ashanti over the course of a year, that's $500,000 that comes in to cover corporate costs. I guess using a dollar rate that we've had first quarter that we were operating that JV, fourth quarter last year, there was about $1.5 million of expenditure. So annualise that, and you're on a pretty good run rate of getting towards that sort of $10 million rate, and that's what we're sort of saying. We're probably one new deal, one more further partnership away from getting to that. But I should also mention there are other projects, Alistair, that we're not operating and managing, that partners are coming in and they're doing the exploration. So that gives shareholders upside to those programs that are taking place as well.
So not every company can get a deal like that with the likes of AngloGold Ashanti. So they must be looking at something about your projects and seeing something they like there.
Well, and that's the interesting thing of as we were talking about before, is how do investors do the work to understand technical results? What should they look out for? And that's one of the attractiveness of having these partners in there, is that hopefully they've come in and done the work to understand the exploration concepts, put their money where their mouth is by funding that and taking on the exploration risk, but also they're providing a stamp of approval to the team and the company, because they're not going to lend their brand and their name to juniors that I guess don't pass their due diligence processes from a personnel perspective.
So just a final question. I'm going to throw you a googly now, since we're in you're in Australia. I won't say curveball. Googly, I think, is more appropriate. You mentioned Ocean Equities in the middle of our conversation. Have any of the roster of former colleagues of Ocean Equities got shares in Kincora?
Oh no, there's been some very good support from the old Ocean guys. Still keep in regular contact with a lot of them, and it's great to see them, whether it's sort of on the corporate side, on the investment side, on the broking side. There's a really good network of people there.
So you're not getting any negativity or people shorting you because of old grudges from those crazy days.
Not that I'm aware of, Alistair, but we're actually just working through the tail end of a large shareholder overhang at the moment, which will hopefully be done in the next week or two. But yeah, you generally only find out when people are off the register.
Yeah, right. Well, good luck with it all, Sam. It's been really great to catch up, and I wish you all the best for 2025 and beyond.
No, great to catch up and good to see you.